Holy moly, folks. Welcome back to another Federal Reserve FOMC meeting. That is the Federal Open Market Committee meeting in which we find out what the Federal Reserve is up to in their dark and mysterious caves of determining what the policy rate is going to be going forward. Now, the biggest question that we have going into this is, first of all, what do we think the Federal Reserve's terminal rate is going to be? Right now, we think that terminal rate is going to be somewhere around 3.75%. So we'll be looking for clues on that. We'll also be looking for clues on Jerome Powell's definition of a recession. And we'll be looking for any kind of clues that Jerome Powell gives us on the Powell curve you've been talking about is getting a little dangerously close to inversion. So are you going to give us any kind of insights on that? Well, first, in about the next 3 minutes, we're going to find out what the Federal Reserve policy statement has in store for us. The policy statement is a pretty unique tool. This time we do not have a summary of economic projections coming towards us. So that means we don't get any kind of crazy estimates in terms of what they think inflation is going to do by year end, or what they think GDP is going to do by year end, or any of that kind of madness. We're just simply going to get, is the Federal Reserve raising rates by 0.75%, which is 75 basis points, or is the Federal Reserve raising rates by 100 basis points, or a full 1%. So far, the market believes that we are going to see, according to the rate monitor tool, with a 72% degree of certainty, we are going to see a 75 basis point hike. In fact, that has just moved up within the last hour to, I've frozen a little bit here. That's bad. There we go. It has just moved up within the last hour to 79.3%. 79.3%. That is the current expectation for a 75 basis point hike. And generally, the Federal Reserve likes to match that. They don't like to rug pull us. So we're going to be looking for, again, those three things. We're going to be looking for the Federal Reserve's definition of a recession. We'll see how that aligns with Joe Biden's definition of a recession. If it differs from Joe Biden's definition of a recession, what's interesting is we'll actually have a Fed that purposefully unaligns with the White House. So I wouldn't be surprised, because Jay Powell likes to be pretty apolitical here as best as he can. I wouldn't be surprised to see a little bit of a blowing off over here when we get questioned about Jay Powell's definition of recession. So we're going to be looking for clues about the terminal rate mostly, and Jay Powell's definition of the Powell curve. The Powell curve, if you didn't watch this morning's video, which you really should have, is obviously the difference between the 18-month futures on the 3-year yield curve. You'd know all about this. You'd be an expert if you watched this morning's video. You got to be subscribed to see these things, okay? And the present 3-month yield curve. So we will see. But anyway, we are now just within about 30 seconds away of the FOMC meeting statement, which will provide us data on the rate decision. What kind of rate are we going to expect? We have that data up right now. Stand by. We are within 30 seconds of this right now. Actually, we are stand by within about 10 seconds of the answer. We're waiting for a 75 BP hike. That's what we're expecting. 5 seconds, 10 seconds-ish here. Fed raises 75 BP. Here we go. 75 BP to double down on inflation. Inflation remains elevated, reflecting imbalances. Fed repeats ongoing rate increases likely will be appropriate. Fed raises rates to 2.5%. We've got, let's see, coming through the tape here. It's coming through so damn fast. Oh, man, we went from 1.5 to 2.25. We are raising 75 basis points. The Fed is highly attentive to inflation risks. Spending and production are softer, though job gains are robust. However, the Fed is maintaining 75 basis points in a unanimous vote, folks. That means a Federal Reserve Fed voting member, Esther, voted for the 75 BP hike versus the 50 BP hike she voted for last time. This is a unanimous 75 basis point hike. Treasuries holding steady after the 75 BP hike. Fed notes are noting that spending and production, again, have softened, but that hiring has been robust, that unemployment remains low. 75 basis point increase comes as the Fed attempts to lower high inflation. Fed raises again by 75 basis points. as investors brace for recession. The Fed is strongly committed to bring inflation down to 2%. No time frame for that, although we do have the Federal Reserve policy of FATE, which is flexible average inflation targeting to average 2% inflation over time. They do see and anticipate ongoing increases. But again, we do have, as expected, 75 basis points, my friends. Ongoing increases again, likely highly attentive to inflation risks. 2-year Treasury yields reverse drop after Federal Reserve decision. NASDAQ and S&P hold gains after hike. Market widely expecting this. Again, we had a 79% chance of this. Federal Reserve does see the economy softening, which is a sign that the Fed is attentive to the fact that, yes, we are starting to see that that 3-month Treasury starting to potentially invert on the Powell curve. We're going to go ahead and pull up the statement to see if there's any kind of unique juice in the Federal Reserve statement. It is unlikely that there's any kind of real juice beyond what we've just stated in the Federal Reserve statement, although we will go through it. Most important is obviously going to be the press conference coming up in about 30 minutes. And of course, that coupon expiration tomorrow, which is July 28th, when we have coupon expiration. The FOMC meeting conference call, or I shouldn't say conference call, the investor Q&A or media Q&A will be in about 27 minutes. We have looking, I'm parsing notes right now. Again, Fed repeats ongoing rate increases likely will be appropriate. Esther George again in favor of the 75 basis point hike. Let's go ahead and just write down here that 11:30 a.m. PST for J. Powell presser. We're going to go ahead and throw that up on screen here so we have it for you on screen as a reminder. We've got about 27 minutes to go before the J. Powell presser. All right, let's go ahead and look at the actual statement itself here. Although we've already kind of got the conclusion of it, we may as well just take a brief look here at the actual presser. So we've got recent indicators of spending and production have softened. Very interesting. The Federal Reserve is choosing to make that the first line of the statement here. Nonetheless, job gains have been robust in recent months and the unemployment rate has remained low. Remember, this is one of the most odd recessions ever, if we are indeed in one, where job gains are actually going up rather than down. Usually right before a recession or during a recession, you actually see job loss. Although by the time you start noticing job loss, it's too late for you to position your portfolio any differently. So generally, you don't want to look at job losses as a leading indicator. Generally, job losses are a lagging indicator that, yes, you are indeed in a recession. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and broader price pressures. Now, this is going to actually be a very, very interesting thing that I want to see the Federal Reserve talk more about. I want to see if they take the approach of what I call the hot air balloon method. The hot air balloon method suggests that inflation was really this transitory hot air balloon that came around with COVID, and we were expecting inflation to balloon, hence hot air balloon, with the first COVID pandemic, where all of a sudden you actually had people reducing prices because they're like, oh crap, we are about to go into a nasty recession. So let's drop prices to try to empty the shelves. And all of a sudden we got all this crazy stimulus money. So what did we get? We got inflation. And then when we compared back and we looked at the base effects, we're like, oh, damn, that is high inflation. Then, of course, what else did we have to elevate inflation after that? Well, of course, we had the Delta variant, because who couldn't have predicted that, of course, there'd be another variant. And then, of course, inflation cooled a little bit. And then we're like, oh, but no, Omicron. And then we're like, oh, but of course, Putin's going to go to war. So we're just straight up screwed. But that, of course, is the nature of the inflationary hot air balloon, which a lot of people see as suggesting that the Federal Reserve lied to us about inflation being transitory at first. I actually don't go as far as suggesting that the Fed lied to us about inflation being transitory at first, although, of course, that's a popular sentiment that's very easy to echo, which I've toyed with echoing in the past. Let's be real. There's no way we could have predicted Delta or Omicron or a war with Ukraine. But then again, there's some trains of thought that no, those were entirely predictable. Fine. Fair enough. Let's go ahead and continue to the statement. Everybody's entitled to their opinion. So Russia's war against Ukraine is causing tremendous human and economic hardship. So notice what they're doing here. They're telling you that, look, spending and production are softening, right? That's fine. So spending and production are softening, though that doesn't necessarily mean they're declining. And this is actually a very important statement because there's a very big difference between decline and soften. And I really want you to think about that for a moment. So declining, hold on, we're losing the mic here. We're losing the mic. Oh, sorry if that's loud. Oh, I gotta tape that on a little better. Woo! Getting a little shreddy in here, so let's go ahead and get that cosmetic medical tape or whatever the heck we call it out, and just go ahead and slap on another layer, shall we? Oh yeah. Ooh, yeah. Okay, sorry. Anyway, so it's really important to remember the difference between declining and softening. So declining means that if we're at a 0%, let's say, threshold here, a decline would mean something like negative 1% year over year, like Nike's revenue. Sorry, Nike, you had it coming, okay? A softening means, hey, we were growing credit card spend at 33%. Now we're growing at 20%. We're still growing, like we're still enlarging. We're still getting bigger, which means the party could still keep going. You know, when things are enlarging, the party could keep going. But what we don't see is a decline. And the Federal Reserve is very, very clear here in their word choice that we're not seeing decline, that indeed we are seeing a softening. Very, very different. Okay, so we're seeing a softening at the same time as job gains are robust. Okay, good. This is very true. At the same time, we are seeing the JOLTS indicator go crazy. Remember, the JOLTS indicator is the job openings index. We are still, even though we've seen tech layoffs and hiring freezes, we are still sitting at 1.9 job openings per unemployed person. This is freaking ridiculous. Absolutely ridiculous. Now, the committee seeks to achieve maximum employment and inflation at a rate of 2% over the long run. Keep in mind, this phrase here, folks, very critical language here, over the long run. Why? Because it has to do with FAIT. F-A-I-T. What does it stand for? Let's cheer it. Flexible Average Inflation Targeting. Yeah, seriously, it's nothing to get excited about. It's just basically the Fed's way of saying, hey, if we're wrong for a few years, don't worry, it'll average out to be just totally fine. And sorry, it actually sounds like fate, but it does. Anyway, in support of these goals, the committee decided to raise the target range by 75 basis points. Remember, we generally count by what happens on the lower end. We went from 1.5 to 2.25, which is a 75 basis point hike. Now, in addition, the committee will seek to continue reducing its holdings of Treasury securities and agency debt, as prescribed by basically their plans for quantitative tightening. Now, this is very interesting, and it confuses a lot of people. The way that quantitative tightening works is very confusing to folks, so that's fine. Quantitative tightening can do two things. Number one, quantitative tightening can mean the selling of mortgage-backed securities. The reason you might potentially sell mortgage-backed securities is because mortgage-backed securities have a very long duration in the terms of 15 to 30 years. So in order to actually reduce your holdings of these, you're not going to sit around and wait for a roll-off, which means bond expiration, and you're going to just sell them on the open market, potentially even for a loss. And Jay Powell has told us, even if we sell MBS or mortgage-backed securities for a loss, don't worry, we've had plenty of gains in the past, so our previous gains can offset our losses. Now, some people don't understand what this means, so let me make this really freaking crystal clear. If I lend you $1,000, that means you got $1,000 of cash. And what did I get instead? I, or Kevin, got an IOU, okay? That's what I got. I got an IOU that I'm going to get that money back. That IOU is also known as a bond. A bond is basically an IOU, and I'm going to pay you interest over time. However, if this bond is only written for 12 months, then what does that mean? That means after 12 months, this transaction reverses. Kevin gets his $1,000 back. You get your interest back. Cool. And then Kevin could go out there and continue to buy new bonds, or essentially give out these $1,000 or whatever and get these IOUs. Or I could just say, F it. You know what? I'm just not a buyer anymore. And if you're just not a buyer anymore, that means you're no longer injecting that cash into the economy. That is a form of roll-off tightening, okay? So there are two types of tightening. There's just roll off of generally the T-bills, or there's the sale of mortgage-backed securities. They have not yet started the sale of MBS or mortgage-backed securities. So everybody's got to chill out when they start trying to shout in the comments or wherever the hell they try to shout it. You just said you can actually selling bonds. They've literally been talking about selling MBS for the past 6 months. They haven't actually done it, and that's fine. They're just rolling off the T-bills and not buying as many back. That's fine. But they've been talking about that MBS, so it's important to just pay attention to that. Because in theory, okay, and all this crap is in theory because it's all balanced by what the market ends up deciding to do. In theory, if the Federal Reserve says, hey, you know what, we have all these IOUs and we're just going to dump them, we want our cash back, then in theory, they lower the value denominated in dollar of those bonds, but they actually increase yields. And see, what's very, very important to remember is that when the Federal Reserve increases yields, what happens when yields increase, folks? The dollar goes up. It's that simple. The dollar goes up when yields go up because it means the risk-free rate of return is higher. Because if anyone in the world wants to make a YOLO bet and suggest which country is going to be the last to default, I don't give a crap who you are or what country you're in. You are a complete idiot if you do not say it is the United States dollar and the United States, okay? The full faith and credit of the United States, even for you crypto enthusiasts, is still the most confident thing that you can put your money into in the world. And hopefully the last crypto crisis has helped teach us that. But anyway, continuing on to the statement here, in addition, the committee will continue to reduce its holdings. Okay, we just explained that, blah, 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 committed to 2% in assessing the appropriate stance for monetary policy. The committee will continue to monitor the implications of incoming information for economic outlook, blah, 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 blah. Okay, look, the number one thing that you freaking need to remember is that first, okay, inflation expectations go down. It's very, very simple. I literally just tweeted a picture of this. I'm going to pull up the tweet of the picture. Oh, nope, that's Lauren and I kissing. That's not for you. I didn't have it on screen. That made you look. Yeah, anyway, sorry. Okay, so this is a picture of inflation expectations. Right here in the white is actually inflation expectations. And what generally happens is inflation expectations almost always go down first, and then CPI comes down. And folks, inflation expectations are at the lowest level that we have seen in a year. And that suggests that CPI is likely to come down within the next 3 months. And if you're blind to iron ore prices coming down, which is an industrial metal, if you are blind to copper prices coming down, which keep in mind that electric vehicles use 4 times as much freaking copper as ICE vehicles, which if you don't know what that means, ICE vehicles, internal combustion engine vehicles, use copper. Okay, EVs use 4 times as much. Okay, just to make that clear. If you're blind to iron coming down, copper coming down, lithium prices stabilizing, wheat a little volatile because of missiles. Okay, the darn missiles, I get it. But commodities are coming down. Gas prices peaked in June, and guess what? The bottom of the stock market was in June. So if you're blind to those things, it's your freaking problem. But so far, the data is suggesting that inflation is peaking. And when this ends up proving to be the peak of inflation, barring any other kind of crazy war with like Taiwan and China or some kind of other inflationary disaster, barring any of that, if inflation ends up proving to be transitory, then you're going to be a little dumb nut idiot if you're still sitting around in cash. It's fine. I don't care what you're doing with your portfolio. It's your freaking problem. But the point is, you got to be aware that if inflation ends up proving that it peaked in June, you're screwed if you're sitting on your hands still waiting for a sign of the bottom. Retail ain't capitulating. The bottom 25% have more money than they did in 2019. In fact, every income demographic has more money than they did in 2019. All these CEOs and hedge funds keep going around going, oh no, the gloom is still ahead of us. I don't know. In my opinion, the gloom is behind us. Okay, I made a video on it earlier, and I can't help but think it's true. The more and more I look at this data, I'm like, damn, this is a lot of gloom, but people keep spending. Like the data just shows that people keep freaking spending money because people actually don't care. In fact, most consumers expect inflation to go nothing but down. Hate to say it, but it's the truth. So that's just what we face right now. That is what we face right now. So Jerome Powell speaks to us in about 14 minutes. And now what I'm going to do is I'm going to go to the beautiful bastards who have subscribed to the members chat or who have still been subscribed to the members chat to chat with me. And I'm going to answer some questions in that members chat right now. And in 14 minutes, we're going to review what Jay Powell says. And if he says stupid stuff, I'm going to talk about it. And maybe we'll also look at some sticks. And you should take advantage of the coupon code that expires tomorrow, because I'm tired of pitching the coupon code. So I'm thinking about just raising the price once and for all, one big fat time, and then not have a coupon code anymore. And then if you want to join our awesome community, you'll have to pay a fat premium. Just something that's on my mind. Just saying. Okay, salty options. What's up, Tesla only dog? All right, demand for copper will drop during recession. Obviously, probably not, depending on countries stimulate, e.g. China. But once the economy picks up, copper demand will rocket. Yeah, I mean, that's entirely an idea. The problem is right now you have PMIs in contraction, okay? Purchasers, managers, indices are in contraction. So in aggregate, we are presently seeing contraction. And that creates some concern. If we're presently in contraction for PMIs, you know, I wouldn't have near-term bets on copper. Would I bet on copper over the next 10 years? Maybe, but generally I don't bet on commodities. Why don't I bet on commodities? Because all it takes is some other douchebags to open up a mine, and boom, what do you get? You have more supply of copper. I don't care about people digging for rocks. I really, really don't. I don't think it's very innovative. I think it's convenience-based. Look, you don't believe me? Go ahead. Look at the chart right here, okay? This is the S&P Global US Composite PMI. It is in contraction at 47.5%. I got the chart right here. You're screwed. Sure, this is going to go, like these indices are going to go back up again when we expand. And honestly, I believe that the second half of this decade is going to be beautiful. Oh, honestly, I'm going to probably take the biggest L ever, and I'll reveal it here live. I will probably take the biggest L ever, loss, for those of you who aren't with it, with like all the zillennial talk these days. That's Gen Z and millennial combined, in case you're wondering. L means taking a loss, okay? I thought that after the COVID pandemic, we might see something called the, I hate to even say it, the frugal decade. But dude, with how much people's pay has gone up, I think I'm going to take the biggest freaking L on this. Like, it's going to be so freaking huge because people are just making more money. And here's what happens, folks. When people make more money, guess what people do? They save more money. Nah, they spend more money. Okay? It's that simple. It's really that simple. They don't save more money. Oh, God, they don't save more money at all. Okay. You think real estate will go down more by January, or is this the bottom? I don't know, man. Real estate prices have started to do this. Okay, they've started to go down. But here's the thing, man. So have mortgage rates. The problem is that the 10-year treasury keeps falling. I need it to be like 3.5% for longer to be confident that this crap is going to crash the real estate market. Hey, we might see a 5 to 10% adjustment with treasury yields where they are right now. But I hate to say it, with treasury yields where they are right now, I'm not going to get a beautiful 20% reduction. I'll be lucky if I get a 10% reduction. Maybe if I get some dumb seller, I'll be able to get a 20% reduction, which is fine. I'll look for it in my Series A and screw all the people who don't think my Series A is a good idea, which actually there are very few of. But I'm really excited about the real estate company we're starting. If only the attorneys who are hopefully watching this could get off your damn ass and finish the paperwork, then you know, things will be great. But anyway, that's their job. They like to cross T's and dot I's, and then they start crossing I's and dotting T's. It's just stupid. But whatever. You know, that's called attorneys. They like to charge billable hours. Anyway, thoughts on Redbox, meme stock. Okay, what about the personal consumer debt bubble? Okay, so in order for you to comment on the consumer debt bubble, which I will also comment on in just a moment, we're going to look something up. St. Louis Fred, debt, personal disposable income. Okay, sorry, I had to write that. Okay, here we go. Yes, this is exactly what I was looking for. Okay, we pulled this crap up live. You find another YouTuber to pull this garbage up for you live. You ain't gonna find it because it's fraud. Sorry, I didn't say that. Anyway, so let's just go ahead and zoom in over here to like 2000 to now. Household debt service payments as a percentage of disposable income. Yeah, debt might be going up, but it's still a lower burden than what it was in 2019, which there weren't a lot of people with debt problems between 2013 and 2019. So YOLO, bring on the debt, baby. Where's my Affirm stock when I need it? All right. Someone here says inflation is not over. It's going up. All right, dude, short the market. Bro, real talk, how much these markets cost? They look Gucci. I don't know. I got them for free. But what if we get oil rug pulled before deflation can happen? You mean like a really high peak of oil? Yeah, I mean, oil has a very big impact and energy has a big impact on headline CPI numbers. So yeah, that's definitely a possibility. Okay, regarding inflation. Ooh, a $10 donation. Holla, $10 donation. Damn. I don't know I was worth $10. I'm going to have to sit up straight for this one. Regarding inflation, thoughts on people still getting mortgage rental forbearance? Thoughts on 6-10-year treasury inversion? Thoughts about student loan moratorium ending after the election? Yeah, look, any student loan moratorium person, consider yourself a lucky bastard, okay? You are so freaking lucky. You have had the longest stimulus checks coming into your bank account every goddamn month. And you should consider yourself lucky. Like, rental forbearance has stopped, mortgage forbearance has stopped, unemployment boosts have stopped. Everything has stopped except student loan forgiveness, okay? Like, if you have a federal student loan and you are here in 2022 listening to this, and you're like, yeah, okay, I'm still taking the check. You should be looking at yourself and being good. Hell yeah. Okay? It is a free freaking stimmy check that nobody else is getting. Consider yourself lucky, okay? What do I think about it macro? Look, I mean, we got like 49 million people in America with this, and I do think it'll affect discretionary income spend. But in the grand scheme of things, I'm not terribly worried about it. It's not something that I really see as like a market-based inflection point. If the market's going up and the market's doing this, and student loan forbearance ends, it'll be like that. Like, who cares? It's not the biggest deal to me. Thoughts on 610 inversion? Really, right now, I'm watching the Powell curve. Watch my video for that. I think that's honestly the most important curve because he the boss driving the ship. And if the captain says one thing, he the dude I'm listening to because I'm on his ship. And so far, it doesn't look like I'm on the Titanic, which is good because at the beginning of the year, I made a video about the Titanic, which was then copied by other people. Which was really disgusting, but whatever. Not bitter at all. Thoughts about student loan moratorium? Okay, we answered that one. Oh yeah, thoughts about people still getting mortgage rental forbearance. I haven't heard of people still getting those forbearances, but good for them. The biggest out of all of the stimulus that existed, the biggest stimulus that ever existed was mortgage forbearance. I kid you not, 18 months, 18 freaking months. Well, maybe not because there's PPP, but 18 months times a $2,000 mortgage is $36,000 basically for free because you could hang it onto the back of your loan. Okay, I correct that though. Honestly, the PPP loan was the biggest grift ever, okay? Because if you got $100,000 from the PPP loan, you were able to write off that $100,000 in expenses as well as get $100,000 tax-free, which basically made that worth about $150,000. This was the biggest grift of stimulus money that has ever existed and probably will ever exist in our lifetimes. The PPP loans were sexy. Yeah, and I don't blame anyone for taking them. Yeah, it's free money, okay? So screw it. Help crypto go up. All right, here. Somebody named CS whatever says, I troll you on the comments. No comments anymore, bitch. But anyway, about embracing, what am I embracing? The Tesla spirit by not advertising, but I actually respect your hustle. Secure the dough. Well, I appreciate that. Thank you for saying that. And thanks for the $9.99. You know, I could buy. Hey, Jack. Jack. Hold that thought. Titanic video was the GOAT. Great. Lots refinanced when rates were low. Millions of homeowners have now hundreds of extra disposable income every month. Stimmy for years. Yeah, well, a lot of people, when you refinance, you get that in lump sum, right? Hold on, I'll talk more about that. Sorry, I had to shout at Jack. But anyway, lots of when you refinance, you get that money in bulk. Usually people blow it right away, so it's not money you got for a while. People getting 40-year loan. I find with me, man, if I could take 40-year loans all year long or all day long for the Series A we're launching, I would be a dumb butt not to take it. Which, even if you're not a course member, although course members are going to get first priority and that coupon expires tomorrow, even if you're not a course member, you might have a chance of getting in about 30 days later if you go to metkevin.com/Series A. Metkevin.com/Series A. Anyway, Jack's not coming, but I was thinking that $9.99 is like a certain amount in Roblox. I don't know if it's like 1,000 Robux or something like that. But anyway, he always asks about it. I do think that end phase is a little overblown right now. And this is a little bit of a danger. See, the thing is, you have to remember this, okay? Stocks get really, really hot right after earnings, but then they become not hot, you know, a month after earnings and 2 months after earnings. So I think there'll be plenty of opportunities to buy Enphase. I love Enphase. It's one of my favorite companies. Everything about their earnings call was so sexy. I almost bought. But no, like, love Enphase, long run. If I had to pick 3 stocks, man, Tesla, Enphase, Apple to the moon. I'm sorry, I shouldn't have said it here. I should have saved it for the course member live stream, but I spilled the beans. I don't know. Maybe I just need another shot of coffee. Anyway, why won't you answer my Tesla question for $4.99? Well, probably because I haven't gotten into it yet or it expired. I don't know what your Tesla question is. I'll scroll up. What's your Tesla question? Where is it? Where's Kevin Sogel? Tesla predictions by end of week. Dude, come on, man. I can't make end of week predictions. What kind of garbage is this, dude? Let's be real. Okay, come on. I can't make end of week predictions. I can barely make predictions, let alone end of week predictions. Tesla end of week. This is ridiculous, man. If you're playing end of the week predictions, man, you are straight up YOLO gambling. Okay, that's all we're doing. All right, my kids, my friends, my loved ones. Let me pop back into the Doomberg here and let's see what the suits are saying, okay? So S&P is up 1.3% after the 75 BP hike. The NASDAQ is up 2.7%. And the Russell small cap 2000 index is up 0.9%. Next up is the press conference with Jerome Powell, which begins at 2:30 with today's 3/4 point increase out of the way. The big question is, what about September? The fact that the FOMC voted unanimously for another supersized hike, even as downside risks to growth have increased and forward-looking inflation data have softened, suggests policymakers are laser-focused on keeping inflation expectations from unanchoring. How funny. That's literally what I said in this morning's video. The number one job Jay Powell has over this next press conference, which begins in a minute, is him spanking us and teaching us a lesson about how important it is that inflation expectations remain low. Is what it is, and it's true. All right. Anyway, so we got to get Jay Powell up now, and that means I need to get a microphone on. Okay, but I'm serious. Like, that's my expectation. Is Jay Powell's gotta keep it real here soon. All right, here we go. So we're going to go ahead and pop this up. All right. So we will pop this over. Make sure L volume's on. Should be good. But I'll come back to that in just a second once we are good to go. Hold on a sec. Let me just do a test here really quick. Interesting. Hold on one sec. Uh-oh. Okay, I will get to the bottom of this. Stand by. Okay. Oh, I know what we can do. Yes, this is what we'll do. I will go right here. Federal Reserve. I will do it through this. And share. Here we go. Share. One sec. Share screen. I promise it's coming. It's coming.
Been through a lot over the past.
Oops, sorry for the echo. Okay, we got to make sure we can hear this. Can we hear that? Give me a thumbs up if you can hear that. Can y'all hear that? Just give me a thumbs up if you can hear that, please. No audio? That's a problem. Seriously? Scheisse. You can't hear it. Why? Oh, scheisse. Oh, man. Okay, I can figure this out. Why can't I hear this? Scheisse. Maybe he has nothing to say. Stop, you're being nice. Okay, well, that's a bummer. Here, hold on. Until I figure it out, we'll do this. No. Scheisse.
Activity in the housing sector has weakened.
No. Sorry, my friends. I unfortunately think I screwed this up. I can't believe that. I'm going to try one different thing. I'm sorry about that. The Q&A is the most important part. I'm devastated. Hold on. Let me try one more time. Otherwise, I'm screwed. Chrome tab. It's a Chrome tab. Oh, I can do it. I can do it. Give me like literally 10 seconds, and I think I can do this. I figured it out. Shit.
Inflation remains
That should be
well
good.
above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In June, the 12-month change in the Consumer Price Index came in above expectations at 9.1%, and the change in the core CPI was 5.9%. Notwithstanding the recent slowdown in overall economic activity, aggregate demand appears to remain strong. Supply constraints have been larger and longer lasting than anticipated, and price pressures are evident across a broad range of goods and services. Although prices for some commodities have turned down recently, the earlier surge in prices of crude oil and other commodities that resulted from Russia's war on Ukraine has boosted prices for gasoline and food, creating additional upward pressure on inflation. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 2.25% to 2.5%. And we're continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy. Today's increase in the target range is the second 75 basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between now and then. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation.
Yes.
Our overarching focus is using our tools to bring demand into better balance with supply in order to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to return inflation to our 2% longer run goal. This process is likely to involve a period of below trend economic growth and some softening in labor market conditions. But such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
This is good. This was really good, folks. He planted the seed for a pause.
Hi, Chair Powell. Thanks for taking our questions. Rachel Siegel from the Washington Post. Wondering if you can walk us through your thinking around the decision not to go for a full percentage point increase.
As we go to the moon.
We saw a ramp up after the May CPI report came in hotter than usual. And then obviously the June figure did too. Was there any discussion of a stronger hike at this meeting? Yeah, thank you.
Sure. So we did judge that a 75 basis point increase was the right magnitude in light of the data and in the context of the ongoing increases in the policy rate that we've been making. I'd say that we wouldn't hesitate to make an even larger move than we did today if the committee were to conclude that were appropriate.
Look at that
That
chart.
was not the case at this meeting. There was very broad support for the move that we made.
Yeah.
You mentioned the June meeting. We had said many times that we were prepared to move more aggressively if inflation continued to disappoint. And that's why we did move to a more aggressive pace at the June meeting, as we said we would do. At this meeting, we continued at that more aggressive pace as inflation has continued to disappoint in the form of the June CPI reading.
QQQ is going like straight up the last 3 minutes.
Thank you so much for taking our questions. Colby Smith with the Financial Times. As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular?
What?
And given that potential tension and signs of any kind of activity weakening here, how has the committee's thinking changed on how far into restrictive territory rates might need to go?
Boring.
So I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral. And I think we've done that now. We're at 225 to 2.5, and that's right in the range of what we think is neutral. So the question is,
bullish.
how are we thinking about the path forward? So one thing that hasn't changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting. So what are we going to be looking at? We'll be looking at the incoming data, as I mentioned, and that'll start with economic activity. Are we seeing the slowdown in economic activity that we think we need? And there's some evidence that we are at this time. Of course, we'll be looking at labor market conditions, and we'll be asking whether we see the alignment between supply and demand getting better, getting closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look at core because core is actually a better indicator of headline and of all inflation going forward.
Yeah.
So we'll be looking at both. and we'll be looking at them for at those both really for what they're saying about the outlook rather than just simply for what they say. But we'll be asking, do we see inflationary pressures declining? Do we see actual readings of inflation coming down? So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target. And it's also worth noting that these rate hikes have been large and they've come quickly, and it's likely that their full effect has not been felt by the economy. So there's probably some additional tightening, significant additional tightening in the pipeline. So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting. So I think the median for the end of this year, the median would have been between 3.25 and 3.5. And then people wrote down 50 basis points higher than that for 2023. So that's, even though that's now 6 weeks old, I guess, that's the most recent reading. Of course, we'll update that reading at the September meeting in 8 weeks. So that's how we're thinking about it. As I mentioned, as it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now. It's one that we'll make based on the data we see, and we're going to be making decisions meeting by meeting. We think it's time to just go to a meeting by meeting basis and not provide the kind of clear guidance that we had provided on the way to neutral.
Dude, this guy first says we look at core, then says we look at headline. Now it's we look at both.
Nick Timmeroso,
Pick one.
Journal. Chair Powell, you've said that your policy works through influencing expectations and that policy needs to be at least moderately restrictive, which means you need financial conditions to stay tight.
Yeah.
Futures market pricing currently implies you will raise rates this year along the lines of your June SEP, but then lower them a few months later next year. Are these expectations consistent with the need to keep financial conditions tight in order to moderate purchasing power and bring inflation back to 2%?
So I'm going to start by pointing out that it's very hard to say with any confidence in normal times what the economy is going to be doing in 6 or 12 months. And so to try to predict what the appropriate monetary policy response would be, I mean, of course, we do that in the SEP, but nonetheless, you've got to take any estimates of what rates will be next year with a grain of salt, because there's so much uncertainty. These are not normal times. There's significantly more uncertainty now.
Quick note, the 10-year has plummeted.
Ordinarily, it's quite high. So again, the only data point I have for you really is the June SEP, which I think is just the most recent thing that the committee's done. Since then, inflation has come in higher, economic activity has come in weaker than expected. But at the same time, I would say that's probably the best estimate of where the committee's thinking is still, which is that we would get to a moderately restrictive level by the end of this year, by which I mean somewhere between 3 and 3.5%, and that the committee sees further rate increases in 2023. As I mentioned, we'll update that, of course, at the September meeting, but that's really the best I can do on that.
You said inflation had been a little bit hotter than anticipated. Has your view of the terminal rate changed since June?
So I wouldn't say it was. I think we didn't expect a good reading, but this one was even worse than expected, I would say. I don't talk about my own personal estimate of what the terminal rate would be.
Wait, that's
I will write down that in.
Wrong chart.
It's going to evolve. It's obviously it has evolved over the course. I think for all participants, it has evolved over the course of the year as we learn how persistent inflation is going to be. And by the time of the September meeting, we will have seen 2 more CPI readings and 2 more labor market readings, and significant amount of readings about economic activity and perhaps geopolitical developments. Who knows? It'll be a lot. It's an 8-week intermeeting period, so I think we'll see quite a lot of data, and we'll make our decision at that meeting based on that data.
Gina. Hi, Jerome. Thanks for taking our questions. Gina Smilek, New York Times. You kind of alluded to this earlier, but I wonder, in the event that you see several months of very weak headline inflation numbers because oil prices are coming down so much, but core inflation continues to be strong or even picks up, I wonder how you would think about that.
It's a good question. Core is
So
important
it's,
going
it's
up.
hard to deal with hypotheticals, but I just would say this: we would look at both, and we'd be asking ourselves, are we confident that inflation is on a path down to 2%? That's really the question, and we'll be making, our policy stance will be set at a level ultimately at which we are confident that inflation is going to be moving down to 2%. So it would depend on a lot of things. Of course, as I mentioned, core inflation is a better predictor of inflation going forward. Headline inflation tends to be volatile. So in ordinary times, you look through volatile moves in commodities. The problem with the current situation is that if you have a sustained period of supply shocks, those can actually start to undermine or to work on de-anchoring inflation expectations. The public doesn't distinguish between core and headline inflation in their thinking. So it's something we have to take into consideration in our policymaking, even though our tools don't really work on the some aspects of this, which are the supply side issues.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. Earlier this week, the president said we are not going to be in a recession.
Oh,
So I have two questions off of that. Do you share the president's confidence in not being in a recession?
here it
And
is.
second, how would or would not a recession change policy? Is it a bright line, sir, where contraction of the economy would be a turning point in policy, or is there some amount of contraction of the economy the committee would be willing to abide in its effort to reduce inflation?
Blow it off, Jay Powell. Blow it off.
So as I mentioned, we think it's necessary to have growth slow down, and growth is going to be slowing down this year for a couple of reasons. One of which is that you're coming off of the very high growth of the reopening year of 2021. You're also seeing tighter monetary policy, and you should see some slowing. We actually think we need a period of growth below potential in order
He's
to
blowing
create
it
some
off.
slack so that the supply side can catch up. We also think that there will be, in all likelihood, some softening in labor market conditions, and those are things that we expect and we think that they're probably necessary if we were to have to get inflation, if we were to be able to get inflation back down on a path to 2%, ultimately get there.
I didn't see your spot.
The question is whether you see a recession coming and how that might or might not change policy.
So we're going to be focused on getting inflation back down, and as I've said on other occasions, price stability is really the bedrock of the economy, and nothing works in the economy without price stability. We can't have a strong labor market without price stability for an extended period of time. We all want to get back to the kind of labor market we had before the pandemic, where differences between racial and gender differences and that kind of thing were at historic minimums, where participation was high, where inflation was low. We want to get back to that, but that's not happening. That's not going to happen without restoring price stability. So that's something we see as something that we simply must do, and we think that we don't see it as a trade-off with the employment mandate. We see it as a way to facilitate the sustained achievement of the employment mandate in the longer term.
Howard Schneider with Reuters. Particularly in regard to expectations, it's been said the last few months that the risks of doing too little outweighed the risks of doing too much. Does that remain the bias?
So we're trying to do just the right amount, right? We're not trying to have a recession, and we don't think we have to. We think that there's a path for us to be able to bring inflation down while sustaining a strong labor market, as I mentioned, along with, in all likelihood, some softening in labor market conditions. So that's what we're trying to achieve, and we continue to think that there's a path to that. We know that the path has clearly narrowed, really based on events that are outside of our control, and it may narrow further. So, I do think, as I said just now, that restoring price stability is just something that we have to do. There isn't an option to fail to do that, because that is the thing that enables you to have a strong labor market over time. Without restoring price stability, you won't be able to, over the medium and longer term, to actually have a sustained period of very strong labor market conditions. So Of course, we serve both sides of the dual mandate, but we actually see them as well aligned on this.
But as a follow-on to that, given the uncertainty and the sort of paradoxical flow of data you've been getting, if you're going to make a mistake, would you rather make the mistake on doing too much, raising too much, than raising too little?
Good question.
We're trying not to make a mistake. Let me put it this way. We do see that there are two-sided risks. There would be the risk of doing too much and imposing more of a downturn on the economy than was necessary. But the risk of doing too little and leaving the economy with this entrenched inflation, it only raises the cost. If you fail to deal with it in the near term, it only raises the cost of dealing with it later. To the extent people start to see it as just part of their economic lives, they start to factor high inflation into their decisions. When that, on a sustained basis, when that starts to really happen, and we don't think that's happened yet, but when that starts to happen, it just gets that much harder and the pain will be that much greater. So I really do think that it's important that we address this now and get it done.
Thanks, Chair Powell. Neil Irwin from Axios. To build a little bit on what Steve was asking, do you believe the United States is currently in a recession? Will the GDP reading tomorrow affect that judgment one way or the other? And has your assessment of the risk of recession changed any in recent weeks?
Pummel them.
So I do not think the U.S. is currently in a recession. And the reason is there are just too many areas of the economy that are performing, too well. And of course, I would point to the labor market in particular. As I mentioned, it's true that growth is slowing, and for reasons that we understand. Really, the growth was extraordinarily high last year, 5.5%. We would have expected growth to slow. There's also more slowing going on now. But if you look at the labor market, you've got growth. I think payroll jobs averaging 450,000 per month. That's a remarkably strong level for this state of affairs. The unemployment rate at near a 50-year low at 3.6%. All of the wage measures that we track are running very strong. So this is a very strong labor market, and it's just not consistent with 2.7 million people hired in the first half of the year. It doesn't make sense that the economy would be in recession with this kind of thing happening. So I don't think the U.S. economy is in recession right now. Haven't seen it, and we'll just have to see what it says. I don't. I would say generally the GDP numbers do have a tendency to be revised pretty significantly. It's very hard. It's very hard to accumulate U.S. GDP. It's a large economy, and a lot of work and judgment goes into that. But you tend to take first GDP reports, I think, with a grain of salt. But of course, it's something we'll be looking at.
Hi, Chair Powell. Victoria Guida with Politico. I wanted to ask about the new conflict of interest rules that you all rolled out. Some senators have written asking for those rules to have more teeth and to have sort of more transparency about the Fed officials' financial activity. I was
Write a
wondering
letter.
if you could speak to that and whether you intend on toughening those rules in any way.
So those are the toughest rules in place, at any comparable institution that I'm aware of. We think, we thought about this carefully, and we put them in place, and we're building the infrastructure so that the enforcement will be tight, that actually you won't be able to make trades unless they're pre-cleared. And the amount of trades you make they'll have to be 45 days or more before any FOMC meeting. It's just, I think we've really, created a very strong and robust set of rules that will, support public trust in the institution. And again, we're just now, this is
Blah, blah, blah. Did you hear Pelosi sold NVIDIA today? Lots. Apparently for like a $300,000 loss. Anyway.
Hi, Katarina Saraiva, Bloomberg News.
Ooh, Bloomberg.
I wanted to ask a little bit more about the 75 basis points versus 50 versus 25. Can you talk a little bit about what kind of goes into your thinking for, making the decision on how much to raise rates? And, just talking about a very large amount that you alluded to, could that possibly be 100 basis points? And then kind of along those lines, is there any sort of weakness in the economy outside of inflation measures that would lead you to slow your hiking pace?
Hiking.
So I'm gonna take that as a question about the next meeting and thereafter. So as I mentioned, we're going to be looking at all of those things: activity, labor market, inflation, and we're going to be thinking about our policy stance and where does it really need to be. And I also mentioned that as this process, now that we're at neutral, as the process goes on, at some point,
Now that we're
it would be
neutral,
appropriate to slow down. And we haven't made a decision when that point is, but intuitively that makes sense, right? We've been front end loading these very large rate increases. Now we're getting closer to where we need to be. So that's how we're thinking about it. And we're, in terms of September, we're going to watch the data and the evolving outlook very carefully and factor in everything and make a decision in September about what to do. And I'm not really going to provide any specific guidance about what that might be.
see these
But
guidance.
I mentioned that we might do another unusually large rate increase, but that's not a decision that we've made at all. So
Maybe.
we are, we're going to be guided by the data. And I think you can still think of the destination as broadly in line with the June SEP, because it's only 6 weeks old, and sometimes SEPs can get old really quick. I think in this one I would say is probably the best guide we have as to where the committee thinks it needs to get at the end of the year and then into next year. So I would point you to that.
Hi, thank you. Chris Rugaber at Associated Press. I wanted to ask about, right now there is a sort of growing gap between the Fed's preferred measure of inflation, the PCE index, and the one that's followed by the public, the CPI, of course. How do you expect to handle this divergence if the PCE starts to come down enough for you to consider slowing rate hikes, even if the public is still seeing much higher CPI ratings? Thank you.
So it's an interesting situation. Of course, we've long used PCE because we think it's just better at capturing the inflation that people actually face in their lives. And I think that view is pretty widely understood. That said, the public really reads about CPI. And the difference really is because the CPI has higher weights on things like food, gasoline, motor vehicles, and housing than the PCE index does. And so that accounts for a lot of the difference. However, over time, they tend to come together. We were given the importance in the public eye of CPI. We are calling it out and noticing it and everything like that. But remember, we do target PCE. That is because we think it's a better measure. They will come together eventually. The typical gap was really about 25 basis points for a very long time. And if it got to, 40 basis points, that would be very noticeable. Now it's much larger than that because of the things I mentioned. So we'll be watching both, but again, the one that we think is the best measure always has been PCE, at least since I think we some 20 plus years ago moved to PCE.
Blah blah. Give me some juice.
I'd like to weave a couple of things together, Mr. Chairman. Michael McKee from Bloomberg TV and Radio.
Bloomberg.
You said that the destination pretty much remains the same in terms of your end of the year target, but where are you in the journey? We've now seen the federal stimulus programs end. You mentioned consumer spending, business investment have slowed. Are they moving at a pace you would expect, or is demand still greater than supply, too much greater than supply, that you need to do significantly more? And I ask because there are lags in the impact of monetary policy, as you mentioned, and a lot of this might hit in 2023. The strong dollar effect may hit in 2023 when the economy might be weak. How do you know where you are and where you think you need to get to?
Well, just talking about demand for a second, as I mentioned in my remarks, I think you pretty clearly do see a slowing now in demand in the second quarter. Consumer spending, business fixed investment, housing, places like that. I think, people widely looked at the first quarter numbers and thought they didn't make sense and might have been misleading in terms of the overall direction of the economy. Not true of the second quarter, but at the same time, you have this labor market. So there are plenty of experiences where GDP has been reported as weak and the labor market is strong and the economy has gone right through that and been fine. So that's happened many times. And it used to happen, if you remember, in the first quarter of every year for several years in a row, GDP was negative. and the labor market was moving along just fine, and it turned out to just be measurement error. It was called residual seasonality. We don't know the situation. The truth is, though, we think that demand is moderating. We do. How much is it moderating? We're not sure. We're going to have to watch the data carefully. There is a great deal of money on people's balance sheets that they can spend. The unemployment rate is very low. The labor market's very hot. There are many, many job openings. Wages are high. So it's the kind of thing where you think that the economy should actually be doing pretty well in the second half of the year. But we'll have to see. We don't know that because you do see a marked slowing in the second quarter that is fairly broad. So we'll be watching that. We'll be watching that. Of course, as I mentioned, we do want to see demand running below potential for a sustained period to create slack and give inflation a chance to come down.
Nicole.
This is good, by the way.
Hi, thank you, Chairman. Nicole Goodkind, CNN Business. When does the committee expect to see a meaningful slowdown in the labor market, and
Your
how
mom.
much weakness will it accept with regard to slower job growth and higher unemployment before it pauses or begins to think about cutting rates?
So I think you're already seeing, you've seen in the labor market, what you've seen is a decline from very high levels of job creation last year and earlier this year to modestly slower job creation. Still quite robust, as I mentioned. So you're seeing that. You're seeing some increase in initial claims for uninsurance, although that may actually have to do with seasonal adjustments. We're not sure that that's actually real. There's some evidence that wages, if you look at average hourly earnings, they appear to be moderating. Not so yet from the other wage measures, and we'll be getting the Employment Compensation Index measurement, I think, on Friday, I guess. And that's a very important one because it adjusts for composition. So I'd say you and also anecdotally, you hear much the sort of level of concern on the part of businesses that they simply can't find workers is probably down a little bit from what it was, say, for example, late in the latter parts of last year. So there's a feeling that the labor market is moving back into balance. If you look at job openings or quits, you see them moving sideways or perhaps a little bit down. But it's only the beginning of an adjustment. But I think most also, if you look at, I mean, once you start citing these things, you can't stop. If you look at the household survey, you see much lower job creation, and the household survey can be quite volatile, but it has no jobs created in the last 3 months. So that might be a signal that job creation is actually a little bit slower than we're seeing in the establishment survey. So executive summary, I would say there's some evidence that labor demand may be slowing a bit. Labor supply, not so much. We have been disappointed that labor force participation really hasn't moved up since January. That may be related to yet another big wave of COVID, and there's evidence that that's the case. But so we're not seeing much in the way of labor supply. Nonetheless, I would say some progress on demand and supply getting back in alignment.
Yeah.
Before you think about pausing rate cuts?
So I think we're going to be looking at inflation as well. We you know, as I mentioned, we need to see inflation coming down. We need to be confident that inflation is going to get back down to mandate consistent levels. That's not something we can avoid doing. That really needs to happen. But we do think, though, that the labor market can adjust because of the huge overhang of job openings, of excess demand, really. There should be able to be an adjustment that would have perhaps lower than expected increases in unemployment, lower than would be expected in the ordinary course of events, because the ratio of vacancies to unemployed is just out of keeping with historical experience, and that suggests that this time could be different.
Oh, he said the words.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So you said the path may be narrowed to avoiding a recession. So how close are we to a recession? And then how do forecasts of possible recessions from banks and economists, how does that make a soft landing you've talked about more difficult?
So as I mentioned, it doesn't seem that the U.S. economy is in recession right now. And I think you do see weakening, some slowdown, let's put it that way, in growth, and you see it across some of the categories that I mentioned, but there's also just the very strong data coming out of the labor market still. So overall, you would say that in all probability, demand is still strong, and the economy is still on track to continue to grow this year. But the slowdown in the second quarter is notable, and we're going to be watching that carefully. Sorry, what was a lot?
Forecasts, how to bank forecasts of possible recessions, economies. Does that affect the soft landing?
Well, we've said since the beginning, I think that having a soft landing is what we're aiming for. Of course, that has to be our goal. It is our goal, and we'll keep trying to achieve it. I do think events. At the beginning, we said it was not going to be easy. It was going to be quite challenging to do that. It's unusual. It's an unusual event. It's not a typical event given where we are. If there is a path to it, and we think there is, it is the one I mentioned, that the labor market actually has such a large amount of surplus demand that you could see that demand coming down in a way that didn't translate into a big increase in unemployment as you would expect in the ordinary course, because frankly the imbalance is so much greater. But we don't know that. I mean, this is a case of first impression. So anyone who is really sure that it's impossible or really sure that it will happen is probably underestimating the level of uncertainty. And so I would certainly say it's an uncertain thing. Nonetheless, it's our goal to achieve it, and we'll keep trying to do that.
Thank you, Mr. Chairman. Jean Young with Market News. I wanted to ask about the balance sheet reduction program. It's been working for a couple months now and in a different environment than the last time the Fed did it. What are you learning about how it's working and how markets are reacting?
Nothing.
And is reaching the minimum level of reserves needed in the system still several years away at the current pace?
Too early,
so we think
and yes.
It's working fine. As you know, we tapered up into it, and in September we'll go to a full strength, and the markets seem to have accepted it. By all assessments, the markets should be able to absorb this, and we expect that'll be the case. So I would say the plan is broadly on track. It's a little bit slow to get going because some of these trades don't settle until for a bit of time, but it'll be picking up steam. So, and I guess your second question was getting, the process of getting back down to the new equilibrium will take a while, and that time it's hard to be precise, but the model would suggest that it could be between 2.5 years, that kind of thing. And this is a much faster pace than the last time. Balance sheet's much bigger than it was, but we looked at this carefully, and we thought that this was a sensible pace, and we have no reason to think it's not.
Yeah.
Hi, Chairman Powell. Brian Chung, Yahoo Finance. Looking at financial conditions, it seems like the tightening has slowed as of late, with the 10-year coming down, 30-year fixed mortgage rates also going a bit sideways when we talk about a hot housing market still.
Ask it.
Just wondering if you find financial conditions tight enough, especially as you continue to raise rates.
Okay.
So a big piece of that is inflation expectations, break-evens coming down, which is a good thing. It's a good thing that markets do seem to have confidence in the committee's commitment to getting inflation back down to 2%. So we like to see market-based, readings of inflation expectations come down. Broader financial conditions have tightened a good bit. I mean, the way this works is we set our policy, and financial conditions react, and then financial conditions are what affects the economy. So we don't control that second step. We're just going to do what we think needs to be done. We're going to get our policy rate to a level where we're confident that inflation will be moving back down to 2%. Confident. So that's how we're going to take it. And of course, we'll be watching financial conditions to see that they are appropriately tight and that they're having the effect that we would hope they're having, which is to see demand moderate and inflationary pressures recede and ultimately inflation come down.
Thank you, Chair Powell. Greg Robb from MarketWatch. I wonder if you can go back a little bit in time to before there was this outbreak of inflation, when the committee put in place forward guidance on tapering asset purchases. I think it was December 2020. There's a recent speech by Fed Governor Waller talking about that and saying that maybe that was too tight, that kind of condition, and it put you a little bit behind. Not his words, but maybe, we're kind of late to react to some of that inflation. So could you talk about that decision, and have you looked at it in hindsight at all? Thank you.
So yeah, we said that we wouldn't lift off until we had basically achieved our dual mandate goals. And the reason we did it in real time was that the first look at the new framework that we'd rolled out, plenty of people were saying, oh, it's not credible, you'll never get inflation to 2%. Some of our critics now who say inflation is too high were the same ones who were saying you'll never get to 2%. Well, but anyway, that's what happened. So we thought we needed to really make a strong statement with that. It wasn't part of the framework. The December 20 guidance was not part of our overall new framework. It was just guidance that we put in place. So I would say two things. One, I don't think that has materially changed the situation, but I have to admit, I don't think I would do that again. I don't think I would do that again. We, ultimately the situation evolved in a highly unexpected way for all of us. And, maybe the learning is that leave a little more flexibility than that. But did it matter in the end? If you look at, I really don't think it did. I'm not sure it would have mattered if we'd been raising rates 3 months earlier. Does anybody think that would have made a big difference? I mean, lots of central banks were raising rates 3 months earlier, and it didn't matter. I mean, this is a global phenomenon that's happening now. Admittedly different in the United States, but anyway.
Just a lot of people talk about that time, and they talk about a taper tantrum that I know you haven't talked about it too much, but that you were worried at the time about repeating that taper tantrum that you had experienced as a governor. So was that part of that? Where did that fit into all this? Thank you.
So I think we learned there have been multiple taper tantrums, right? So there was the famous one in 2013. There's what happened at the December 18 meeting where markets can ignore developments around the balance sheet for years on end and then suddenly react very sharply. So we just had developed a practice of moving predictably and doing it in steps and things like that. It was just like, that's how we did it. And so we did it that way this time. We were careful to take steps and communicate and all that kind of thing. We were trying to avoid a tantrum because they can be quite destructive. They can tighten financial conditions and knock the economy off kilter. And when it happens, you have to really, in both 13 and 18, really had consequences for the real economy, 2, 3, 4 months later. So we were trying to avoid that. That was part of it. Again, I don't think that's the real issue of 2020 and 21 was just trying to understand what was happening with the reopening economy. That was where the big uncertainty was. And our view was that these supply side issues would get better, that people would go back to work, that labor force participation would come back, everyone would get vaccinated, schools would open, kids would be in school, and labor force participation would jump back up. That was very broadly thought to be the case. These supply side issues would get solved reasonably quickly, and they just haven't. They still haven't. So that's really the learning, I think, is around how complicated these supply side issues can be. We haven't seen this before in a long, long time. And so that's really what accounts for the pace at which we moved. And, we did, when inflation changed direction really in October, we've moved quickly since then. I think people would agree. But before then, inflation was coming down month by month. And, we kind of thought we had the story, probably had the story right. But then I think in October, you started to see a range of data that said, no, this is a much stronger economy and much higher inflation than we've been thinking. And again, we pivoted and here we are.
Nancy Marshall-Genzer with Marketplace. Chair Powell, I just want to pin you down a little bit more on the issue of recession. So if we get a negative GDP number tomorrow for the second quarter, would the Fed consider the U.S. in a recession?
Let's go.
And just remind us, what is your definition for the start of a recession?
So the Fed doesn't make a doesn't make a judgment on that. You know, we're focused on the dual mandate and using our tools to achieve maximum employment and price stability. We don't say there is now a recession, that kind of thing. So that wouldn't be something we do. We would look at the data tomorrow, and no doubt we'll look at it very carefully and draw whatever implications we can. As I mentioned, though, you know, if you think about what a recession really is, it's a broad-based decline across many industries that you know, that's sustained for more than a couple of months, and there are a bunch of specific tests in it, and it just doesn't seem like that now. What we have right now doesn't seem like that, and the real reason is that the labor market is just sending such a strong signal of economic strength that it makes you really question the GDP data. But again, that's not a decision that we make, and we won't reach a conclusion one way or another on that.
Yeah.
Thank you very much. Simon Rabinovich with The Economist. You've said that some softening in the labor market is needed. Within the Fed, there are staff economists who've argued that Nairu, the non-inflationary rate of unemployment, might be as high as 5 to 6% right now, which obviously is a lot higher than the current rate of 3.6. What's your assessment of Nairu? Is that something that came up in discussion with the committee?
So I think broadly, a lot of economists think that the natural rate of unemployment will have moved up to some significant extent above where we think it was before. And the reason is it's the usual matching issue where matching has become less effective and that kind of thing when you have the kind of turbulent downturn and the big switches in demand from services to goods and all that. So it could be higher, and my own instinct is that the natural rate of unemployment is higher. Of course, I would add that we don't know it. We can never know where these star variables are in real time with any confidence, but I would say it must have moved up materially. But the other side of that is as all these jobs get created and people go back to work and unemployment is so low, I think you could, in principle, you could see it coming back down pretty significantly. And that would also, by the way, take pressure off of inflation, because it's that gap. It's the gap between actual unemployment and the natural rate that really is relevant for, the negative slack we have in the economy by the overtight labor market. So if you wouldn't observe this. It's an unobservable, but you could actually be seeing inflationary pressures coming down if that does happen. And we don't control that, but that's something that logically, if the pandemic and the disorder in the labor market cause the natural rate to move up, then as the labor market settles down, in principle, you should see it move back down.
Thank you, Chair Powell. Jeff Cox from CNBC.com. Just a question about, hate to keep banging the drum about recession, but most of the polls that we're seeing now from the public, people believe that we're already in a recession or heading for one. Economists pretty much the same thing. They're being told by folks like you and in the administration that we're not in a recession, we're not heading for a recession. Frankly, coming from the same people who told them that inflation was transitory, telling them now that we're not heading for a recession. So what would you tell the public to reassure them now that you feel confident in your forecast going forward and the Fed is ready to respond to a potential downturn in the economy?
No, all I've really said is I don't think it's likely that the U.S. economy is in a recession now, and I've explained why that is the case. It's because you do see a very strong labor market, and I think the public will see that as well. Going forward, what we've seen is a slowing in spending, as I mentioned. We've seen the very beginnings of perhaps a slight lessening in the tightness of the labor market, but it would only be the beginnings. So, and I mentioned that I also said that our goal is to bring inflation down and have a so-called soft landing, by which I mean a landing that doesn't require a significant increase, a really significant increase in unemployment. We're trying to achieve that. I've said on many occasions that we understand that's going to be quite challenging and that it's gotten more challenging over recent months.
Thanks, Chair Powell. Kyle Campbell with American Banker.
The FOMC has historically tried to avoid the kind of rapid monetary policy tightening that has happened so far this year. How concerned are you that the rate hikes that we've seen thus far might increase risks to financial stability, not just domestically, but globally?
I mean, there are precedents for the FOMC moving very quickly. For example, 1994, 1980, even more so. So we've been known to do that when it's the appropriate thing to do, and this year it clearly is. I would say that given how quickly we've moved, I'm gratified that while that basically markets have been working, they've been orderly. There's been some volatility, but that's only to be expected. For a financial stability perspective, asset values are down, which in some sense lowers vulnerabilities. It's when they're really high that you would worry that they're vulnerable to a fall. Actually, many asset values have come down. I think you've got a well-capitalized banking system. I think you have households are generally in about as strong financial shape as they've been in a very long time, or perhaps ever, given what the money that's on people's balance sheets. So you have from a financial stability standpoint, you have a pretty decent picture. Now, there are plenty of macroeconomic issues that don't rise to the level of financial stability concerns. By financial stability, we think of that as things that might undermine the working of the financial system. So big, serious things. That's not to say that people at the lower end of the income spectrum aren't suffering, because they are. They're suffering from high inflation. They're going to the grocery store and finding that in many cases their paycheck, it doesn't cover the food they're accustomed to buying. We're seeing actual real declines in food consumption, and it's very concerning. It's very unfortunate, and that's why we're really committed to bringing down inflation. One of the reasons.
Go to Mark, the last question.
Thank you, Mr. Chairman. Mark Hamrick with Bankrate. I can remember when you held your first news conference and you vowed to be a very plain-spoken chairman, and we're thinking today about the impacts of Fed policy on individuals as well. What would you say to individuals or households who may yet lose their jobs in this tightening cycle in the fight against inflation as they try to translate what Fed policy means to them in this complicated economic landscape?
Yeah.
Thank you.
So I guess the first thing I would say to every household is that we know that inflation is too high. We understand how painful it is, particularly for people who are living paycheck to paycheck and spend most of that paycheck on necessities such as food and gas and heating their homes and clothing and things like that. We do understand that those people suffer the most. Middle class and better off people have some resources where they can absorb these things, but many people don't have those resources. So, it is our job. It is our institutional role. We are assigned uniquely and unconditionally the obligation of providing price stability to the American people, and we're going to use our tools to do that. As I mentioned, there will be in all likelihood, some softening in labor market conditions. We need growth to slow to below potential growth. We don't want to, we don't want this to be bigger than it needs to be. But ultimately, if you think about the medium and longer term, price stability is the thing that makes the whole economy work. It's what can give us a strong labor market and wages that aren't being eaten up by high inflation. If you talk to people, again, people who are making wages, relatively low wages, they're the ones who are suffering the most from inflation. So it's all the more reason why we need to move on this. Thank you very much.
There it is. Let's do a summary. Get off of that stage. We's done with you. Don't give any chance to spew any more crap. No more. Abso-freaking-lutely no more. Oh, damn. Dollar fell. Oh, man, we got to do a summary. Wow. Dollar fell even more. Let's write that down. 42 and 6.5. All right. Who's ready for a summary? After this summary, we got to do the course member live stream because that's what we do. After this, we are doing the course member live stream. So if you're in the courses or considering joining those, join me in the next course member live stream right after this summary. All right, here we go. Hey everyone, me Kevin here. Boy, oh boy, here's exactly what just happened with the Federal Reserve. First off, they gave us the 75 basis point hike, which had a 79% chance, a likelihood of happening. And that's what ended up happening. Jerome Powell talked about starting to significantly reduce the balance sheet and, quote, we will be looking for compelling evidence that inflation is coming down. This is the second 75 basis point hike that we have had, considered to be unusually large. And Jerome Powell says that, quote, while another unusually large hike could be appropriate at our next meeting, that decision is dependent on the data that we get. In other words, remember, folks, it is currently July. They are off in August, other than going on the TV to blab about blah, 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 keeping inflation expectations low. But they do not have another FOMC meeting until September. In September, we should have two CPI opportunities. In fact, we'll be able to verify that right now by looking at the FOMC calendar and then the CPI calendar. We will probably have two CPI reports before the September meeting, which is September 20th to the 21st, which means we will next be meeting on one of these FOMC reports and news conferences on September 21st. Mark your calendar for that. We have two CPI reports coming out. August 10th, that's Lauren's birthday. Wish her a happy birthday on August 10th. That'll be the July CPI inflation report. And on September 13th, which is before September 21st, which represents the August data set. So we have two CPI reports to go before the next Federal Reserve meeting. And the Federal Reserve chose to only hike by 75 basis points. As a result, the 10-year went plummeting down to 2.765%. Break-evens fell even more, consistent with the idea that the bond market is correct, that inflation expectations and consumer expectations of inflation are plummeting because inflation will likely be coming down in the next 2 to 3 months, which hopefully in the next CPI reports, the next two, we will see that. So that way we could get a soft raise from the Federal Reserve in the September, November, December meeting. Now, the Federal Reserve was extremely clear in multiple instances to argue that the SEP from June was still valid. Now, it is very important to note this is a very big divergence from what we have previously heard from the Fed. When the Fed had their meeting in January, they said, man, if we could go back to our December notes, we would change all of that. In other words, they thought they were wrong. They said the same thing when they came out with the June notes. Boy, oh boy, the March notes were so wrong. Because remember, the summary of economic projections only comes out on average every other Federal Reserve meeting. So we did not get a new summary of economic projections, or SEP. Instead, Jay Powell reaffirmed this SEP rather than giving us some vague, oh yeah, it would be worse this time. He didn't say that. He actually softened his statement by saying that, what we said in June is pretty much accurate, which means that the Fed expects to get the rate or Fed funds rate to about 3.4 to 3.5% by the end of the year, which implies we have 1 to 1.25% to go. 1 to 1.25% to go could literally be a 0.75, a 0.25, and a 0.25, or more likely, if we get any kind of softness in the data, something like a 0.5, which would bring us to 2.75, 0.25, which would bring us to a 3.2, bring us to a 3 point even, and then a 3.25 on the next 0.25 basis point hike. So really, we don't really need these 75 BP hikes anymore. I believe that by Jerome Powell reaffirming and revalidating this SEP, he has basically taken 100 and 125 or any form of rug pull and said, no chance, baby, no chance. The only chance you got is that you got the best chance right now to get the best deal on Kevin's programs on Building Your Wealth, which have a coupon code expiring on July 28th, because then the price goes up as we add more value and more content. But folks, this SEP really, 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 really important. And it is the first time Jerome Powell has actually reaffirmed one of these SEPs in a very, very long period of time. In addition to that, Jerome Powell also changed the first line of the statement. Usually, the first line of the statement suggests that, hey, following a brief decline in the first quarter, we've seen a meaningful progress of economic conditions. But instead, what did we get this time, folks? We got the following as a very first frickin' sentence, which, if you are a YouTuber, you will appreciate the following statement. Right here at the first sentence, you have 99% retention. Right here, or about, almost halfway through, you have about 45% retention. And over here, you've got about 23% retention. Okay, so Jay Powell and the crew, they know that they're most likely to have most people read the first sentence, which is recent indicators of spending and production have softened, which is basically the Fed saying, hey, what we're doing is working. Hey, but in the meantime, we still have the JOLTS indicator that's pretty damn strong, which suggests that there are 1.9 job openings for every single unemployed person. And hey, keep in mind that as long as we average 2% over the long term via flexible average inflation targeting, also known as FATE, we're Gucci. So it's okay if we had a little bit of high inflation, as long as we can end up averaging 2% over the long run. But folks, we had some really big bangers today, like some juicy bangers today. In addition to the first statement changing, this was probably one of my favorite statements right here, although there's some more juicy ones. Folks, Jerome Powell said the following about getting to neutral. He said, getting to neutral is important. I think we've done that now. 2.25% is where we are now, and he believes that is roughly the neutral rate. Now, Jerome Powell does believe it is appropriate to go slightly above neutral to tighten monetary and financial conditions appropriately. However, he believes we are presently at neutral, which neutral is where we expect to go back to after these rate hikes complete and inflation ends up proving to be transitory. Okay, you can watch the full live stream that I did at the beginning, the first 20 minutes or so when I talked about transitory inflation, if you want to dispute that. But anyway, Jerome Powell did do something that bothered me a little bit again, but he's been kind of, he's kind of been pretty typically doing this lately. At the beginning of the year, he's like, oh yeah, we look at core CPI. Don't worry, we don't look at anything other than core. Then in the last meeting in June, so this was like in January, okay? Then in June, he's like, oh, no. We look at headline. We just look at all CPI. And now here in July, he's like, well, actually, we look at both. So if you're trying to figure out what the hell he's looking at regarding inflation, he don't even know, okay? He don't even know the answer. And that's fine. That's fine. As long as it all goes down, we're good. Now, he was drilled multiple times about his definition of recession. And every time he was asked, he says, we think it's necessary for growth to slow down. We think we're coming off high growth that we had during the reopening year of 2021. And that you are seeing tighter monetary conditions, which could have a lagging effect on the economy, especially with softening labor numbers coming in. But Jerome Powell, as expected, completely blew off the definition of inflation and completely ignored the question of Biden's redefining of a recession. He says that he's not trying to trying to put us on the path of a recession, and that he's really not going to comment about whether or not we're in a recession or not, because while he'll look at the data, he doesn't really care. Okay, fine, whatever. He does believe, however, that acting too slowly is a danger, because if he acts too slowly, then inflation could become entrenched. Fortunately, he does say, though, that inflation does not seem to be becoming entrenched because break-even rates are coming down. This is a very, very critical argument that I have previously made many times this year, and was actually one of the reasons that I sold in January, because these break-even yields were skyrocketing. But generally, break-even yields, as shown on screen now, generally break-even yields precede inflation coming down. They also generally go up before inflation goes up. So break-even yields are a really good indicator because the market is telling you what they expect that CPI will be. And right now, the expectation is that that is going to plummet. At this last reading, when I took this screenshot, it was sitting at about 2.6%. Now, that doesn't necessarily have to align exactly with CPI. It's really the direction that you're looking at. And the fact of the matter is the direction is the lowest we have seen in literally the last 12 months. That means the market has had lower inflation expectations at no point in the last 12 months. Put another way, at every other point during the last 12 months, we have had expectations that inflation would be worse rather than better. And so this is good. We're in a very good position right now. Now, he does again say regarding the hiking pace that we're going to watch the data for September, that we do think that demand is moderating. This is good. This is him saying that, hey, if demand is moderating, our work is working. So he's telling us that the economy is softening. He's telling us that demand is moderating. He's telling us that he's going to wait for the data. And he's telling us that he believes that there are lagging effects of monetary policy. I don't know about you, but I don't think he could be any more freaking clear that we're probably not going to get anything more than a 50 basis point hike in September, unless, of course, there's some kind of crazy data that comes out. So why are we seeing a rally in the NASDAQ and tech right now? Because the NASDAQ and tech probably bottomed last month. And if you've been sitting on cash, I don't know if there could be any better of a sign to go buy. Although then again, I've said that before and things have gone lower. So no guarantees. I ain't your financial advisor and I ain't responsible for you losing money, just like I'm not responsible for you making money. Although if you want to send me a 10% commission of any money that you do make in the market, any market it is, I'll take it. But let me put it this way. Nobody ever does. Okay, so continuing on. Regarding QT, he actually thinks markets are fully accepting of quantitative tightening, which is very interesting because the more we tighten, the more demand the Federal, or I should say, the more supply the market puts on, or the Fed puts on the bond market, which means yields go up. And we're actually seeing yields kind of soften. We're seeing break evens come down, and Jerome Powell gave us zero mention of the forward 3-month Treasury, and nobody asked about it, which was really kind of shocking. Regarding unemployment, Jerome Powell almost verbatim copied my video this morning about inflationary pressures coming down if job openings come down. And he goes on to suggest that if the pandemic caused the labor market to move up, then you should see it come down soon, which means we don't actually necessarily have to rug pull markets to see it come down, because in time it will come down, because it was the temporary effect of the pandemic propping it up. He does see that potentially lower wages suffer the most during inflationary times, although this morning we also made a video suggesting the data shows that lower incomes are actually the ones seeing the highest wage increases. Maybe they're actually not having the biggest burdens in terms of needing to slow down spending. Although, yeah, usually food and gas prices and rents are most felt by those in the bottom quartile of incomes. And ultimately, I have to say, if I were bullish on anything at this point, it would be tech. And honestly, potentially, real estate stocks. Hate to say it, but it's true. Anyway, thank you so much, Odani, for the $10 commission. Thank you so much. Hope to see you when the program's on Building Your Wealth, because we're going live in the course member live stream right as I end this. Thanks so much, and we'll see you in the next one. Good luck, everybody, and enjoy the tendies. Goodbye.